Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Ian Weiner on the line. He's Director of Equity Trading for Wedbush Securities. Ian, how you doing on this Friday morning?
I'm good, thank you. How are you?
We're doing good. Thanks for coming on. Real quickly, we were just talking with Joe Saluzzi of Themis Trading about the flash crash, and you were in the trenches. You were on an equity trading desk for Wedbush, institutional orders, customer orders here. How can you describe that day? And are we going to have more days like that coming up in the future?
Well, I mean, that day was characterized by a lot of different things. I mean, first off, you had clearly the panic in the marketplace overall, and then you had some major unwinding that took place among emerging market funds that needed to sell the overall market in the United States to hedge out some of their positions that they had overseas that they weren't able to get out of. Then what happened is, essentially, you have a lot of leveraged ETFs and other exchange-traded funds that are driving a lot of the market moves these days. There's a significant amount of assets that are allocated to them. And because they have to correlate with stocks on the open, and it's very difficult to do, you had a lot of dislocations that were, pretty incredible looking back on it, especially now. And it was pretty much all related to a lot of ETFs basically being forced to sell a certain amount of holdings and sell them at the market. So what you saw was a lot of market orders and a lot of sort of market orders that were in there as stop-loss orders all get elected at the same time in the morning. And as a result, you had this dramatic sell-off that took place, and it sort of crashed the market.
All right, moving on here. On your radar, emerging markets breakdown here. Is that something that's going to spill over into our markets? What's the cause for it? And what could turn the tide in it?
Well, I think it already has spilled over to our markets to some extent. And I think we've seen it pretty much since the Fed spoke. And I think what's happened is, clearly there's been a deceleration in demand. We've seen it out of China. We've seen it out of Brazil. We've seen it out of, a lot of countries around the globe. And with that, the dollar has gotten a lot stronger. And this has affected our multinationals and their ability to compete. So the risks are clearly that currency is going to continue to be a headwind for a lot of multinational companies in the S&P 500. And the question becomes, well, at what price is this sort of in the market? And, my argument would be that it's pretty clear to me, at least, that, given the action in commodities, right, which are typically your cyclical lead indicator, and given your action in the Dow Jones Transportation Index, which is typically a cyclical leader, it's pretty clear to me that they're telling you that the global slowdown is not over yet. And I think the fact that the Fed didn't raise rates last week points to even more concern. I mean, that's the question, right? I think that's what really got the markets down over the last few days is that, how bad are things out there that they can't even raise rates 25 basis points.
Yeah, but now Janet Yellen comes out and at her speech last night and says, "Yeah, we are going to raise rates and by the end of the year here. That's why you're getting the big run up here in the market this morning." Are you still feel the Fed's too wishy-washy on the issue?
Yes, because if you look at sort of the votes that have taken place, and you look at what the market's pricing in, even though she says, hey, we're going to raise rates, that doesn't mean that it's necessarily going to happen this year. It doesn't remove the fact that there's, real risk of a government shutdown. It doesn't remove the risks of sort of policy around the world. And what it did was it actually introduced, a new uncertainty in the market, which is, are we, beholden to China and other countries to dictate sort of how we're going to run our monetary policy in the United States. And what do all these things do? They compress the multiple on the market. And that's what I think is happening. You haven't seen the earnings cuts yet. You've seen some of them, but you haven't really seen them across the board. And that's why getting into next quarter's earnings season in a couple of weeks is going to be, pretty interesting to see sort of where earnings estimates wind up for the S&P 500, post those earnings calls. So, to conclude sort of what your question is, the anything you look at that's early cyclical points to further downside in the markets. And typically those are what lead, and so those are what you need to go with, in my opinion.
You brought up a good point there, and I just want to highlight on it because Matthew G. in the chat says, how do you think the markets will react to the government shutdown threat next week? Now, it seems to me this happened like a few years ago, correct? And it seems to me the markets didn't take it very well. What's your take?
I think it's going to be the same case. I mean, the market doesn't like uncertainty. And if this government gets shut down, which, people can debate it, I'm not really sure, but it sounds more and more like it's becoming a real possibility, then what that does is it calls into question, once again, anything that touches federal spending. And there's quite a few companies out there that have exposure to that. And in general, it's just one more thing that the market doesn't want to have to think about. The market doesn't want to have to figure out, like, okay, so when's the clock start on this and what happens next? And all these things just add further pressure to the marketplace.
Okay, now moving on here, going back to the earnings and the earnings announcements here and guidance, strong dollar, is that going to take its toll on some companies? What sectors and what companies do you expect to come out with some of the pre-announcements here on the downside?
Well, I think that we've already seen it from Caterpillar, and any global industrial company, any commodity-related company is going to have real issues. And it's a question of now how bad and how much is quote unquote priced in, right? Now I don't know what the answer is, but I would say if you look at the action in Caterpillar yesterday, right, that doesn't lend itself to the argument that it's priced in, right? So I think you got to look at sort of the oil companies and look at sort of what they're saying about earnings, and even in some cases, more importantly, what are they saying about dividends? A lot of the reason to own a lot of these big cap stocks has been sort of dividend yield, and as companies get more and more pressed by the falling price of commodities, and they're forced to sort of reconfigure their balance sheet and cut costs, then it says, well, maybe they cut the dividend, and if they cut the dividend, then that changes the equation for a lot of value investors that own these names specifically for that yield.
Will they cut it loose with it right away, like something like a CAT or an AT&T or Verizon, Procter and Gamble? Where some of these dividend funds, if they cut it, are they just boom, we're just out? I remember when Seadrill did that, the thing got destroyed. You think they're that steadfast in their rules that boom, they cut the dividend, they're out?
Well, yeah. There's. I mean, if you look at sort of why you own a lot of companies and why a lot of funds own, and even individual investors, when they look at sort of, okay, what can I buy with 10-year bond yields where they are? It's like, oh, well, let me own companies that have a higher yield. Well, then all of a sudden that yield comes into play and gets cut, and now you're kind of looking at it like, well, do I really need to own XYZ if my dividend's going down and I'm pretty unsure about the fundamentals of the company, and it's clear that things are pretty bad if they've got to do that? And so that to me is sort of what the question is.
All right, moving on here to the oil patch here, crude oil. Long consolidation period. Goldman Sachs made a call, I believe it was a couple of weeks ago, for $20 oil here. What do you make of this long consolidation? Look, basically the whole month of September here been a pretty tight range here. Is this another consolidation for just another drop back into the 30 handle, or you think we go back up to the 50s?
Well, I mean, those are pretty tight ranges, right? I mean, I think that if you look at the global situation from a pure supply demand perspective in oil, it would seem to me that the demand side of the equation is getting worse, and that the supply side of the situation is growing, right? So in that environment, it's awfully tough to see how oil rallies significantly. For it to go to 30, you're going to need a recession pretty much, I think, globally. So, for me, there's not a very exciting trade either way.
Mm-hmm.
But it's really what you need to see, I think, before people start to get excited about oil again in a meaningful way on the long side is, you need to see some companies go out of business. You need to see, a ton of capex cuts, which you've seen some, and all of that would lend itself to, all right, well, some supply is coming off the marketplace, and it's kind of like, well, let's just see what happens. But to me, if you look at the second derivative of demand and supply, they're both going the wrong direction right now for oil to go up.
Yep, talking fundamentals here. Gold caught a bid yesterday, held the $1,100 level, sprinted up towards 1150 here. Been fairly quiet here. Just still looking for the trading range for gold, or can we finally maybe hold this 1150 level, get back over 1200, which we haven't seen in a long time?
Yeah, I mean, I think that it's going to be difficult for gold to kind of, do a meaningful move either way. I mean, I think that the issue with gold is that most people assume world imploding, gold safety, but the flip side is gold is also a commodity based on supply demand, and gold is also a function of demand out of India and demand around the globe from a pure sort of consumption, not just sort of, well, it's an inflation hedge. And since there's no inflation anywhere, the bull case on gold getting meaningfully higher from here is also difficult to sort of put together.
Okay. Just moving on here. Just get your comments on Apple. Basically, we are the high of the rebound. Been 116.89. Had four highs last week. Up into 116 handle. Just really impressive move off the flash crash lows here. Any take on Apple for our investors and traders?
Well, here's the thing with Apple, right? It really comes down to this. Do you believe that they are continuing to innovate in a way that's going to continue to drive people coming into the new phone? Now, I don't know what they'll say and what will happen here today with the new phones, but a couple things to keep in mind. One, in general, the form factor hasn't changed. It's some upgrades in various sort of components. Two, this year they're selling into China right out of the gates. So the numbers aren't, no pun intended, apple to apple, because last year they didn't include China. This year they are. So the numbers are going to look a little better than they did. And, at the end of the day, the question becomes, like, all right, what is Apple's story? Is it just a buyback and cash return story, a financial engineering story, or is it an innovation story? And if it's not an innovation story because the watch and Apple Pay and Apple Music and all these other things are kind of, like whatever, they're not that exciting, then you're not going to get any multiple expansion. And, if you look at the way that they've earned, you can make an argument that they've been over-earning for a long time. And the last quarter, they had peak revenue growth, peak earnings growth, peak margin growth, and, the competition is increasing, and especially in China, where you have low-end smartphone providers. And given the fact that, 30% of their revenues at this point are coming from China, it's hard to say. I have no idea what's going on in China, but it would seem that there's at least enough uncertainty to keep the thing from exploding up, and at a $700 billion market cap, there's got to be something really special to get new money in the door. So to me, you're kind of, towards 120. I'd be selling the stock.
Yeah, you don't think Apple Pay or the Apple Watch are going to be, meaningful enough innovations?
No, I don't.
Okay. Bobby Biddy also is asking here about Oracle. Oh boy, hanging out near the FCL lows here. Any take on Oracle?
Yeah, I mean, Oracle is sort of, in no man's land because I don't think they really understand or really know who or what they want to be. The last quarter was a disappointment. I don't think there's anything that really points to, anything great going on here. I think the most exciting thing that it could do would be to buy another company and add to, some growth because the organic growth isn't that great. To me, it's a do nothing. I mean, it's another one of these kind of big cap tech dividend yield stories, and it's safe. I don't think it's getting killed, but if you're looking to make money from stock price appreciation, I don't. This is not the name I would own.
Okay, all right. Just final comments here. We're quite a distance off the flash crash lows. We nowhere near that 2011 75 here that we hit on the Fed announcement. Just any take on just on the overall market? Do you expect us maybe to test those flash crash lows, or I'm sure a lot of it would be depending on the Q4 earnings, but just a time of caution in the markets.
Yes. My prediction is that we will see 1850 in the S&P by the end of the year,
Okay.
and 1700 in the next 1700 in the next
We
6
got a
to 9
bear
months.
on the line here. Okay, my kind of man here. Ian Weiner, Directory of Equity Trading for Wedbush Securities, joining us here on Benzinga's Pre-Market Prep with just a great outlook on a lot of stocks, a lot of sectors, commodity as well. Ian, thanks for joining us. We'd like to have you back on again soon.
Anytime. Thank you.